We want to start today with something that might feel a little uncomfortable because we're going to talk about our parents and the money advice they gave us and why, despite coming from a place of genuine love and real experience, some of it might be quietly holding you back.
And before anyone closes this episode, we are not here to disrespect anyone's parents. We're not here to say the previous generation was financially irresponsible or didn't know what they were talking about. That's not the point at all.
The point is something much more specific and actually much more interesting. The point is that financial advice is not timeless. It doesn't exist outside of its context. What worked brilliantly in one economic era can be genuinely harmful advice in a completely different one.
And the gap between the economy our parents grew up in and the economy we're navigating right now is not a small gap. It is one of the widest economic generation gaps in modern history.
So when your dad tells you to just work hard and the company will take care of you, he's not lying. He's not making it up. He's telling you what was true for him, what he lived, what he watched work for the people around him.
He just might not realize that the world that made that advice true no longer exists.
And that's what today is about. Not proving our parents wrong, but understanding why their advice made sense for their world and what you need to think differently about to succeed in yours.
Let's start with the biggest one, the one that probably more young people have heard from their parents than anything else on this list.
Go to college, get a good degree, get a stable job, and you'll be fine.
And for their generation, this was not just reasonable advice. It was almost mathematically correct. The college wage premium in the 1970s and 80s was significant, but the cost of college was also a fraction of what it is today. You could work summers, take on modest loans, graduate with manageable debt, and walk into a job market that genuinely rewarded the credential.
The numbers were fundamentally different. In 1980, the average annual cost of a four-year public university was around $3,000. Adjusted for inflation, that's about $10,000 in today's money. The actual average cost today is closer to $25,000 per year, and that's before room, board, and everything else.
So the math that made college an obvious financial win for our parents' generation, that math is genuinely broken for a lot of degrees in today's market. The credential costs 4 times more in real terms, and the job market doesn't reward it 4 times more than it used to.
Which doesn't mean college is always wrong. It absolutely isn't. For certain careers, medicine, law, engineering, education, it remains essentially mandatory. And for many people, the social and intellectual experience has real value beyond just the salary premium.
But the blanket advice, any degree, any school, any cost, you'll be fine. That advice can lead a 22-year-old into $100,000 of debt for a degree in a field with a $40,000 starting salary. And that math doesn't work regardless of how hard you're willing to work.
The updated version of that advice is this. Think of a degree as an investment and apply investment logic to it. What is the cost? What is the expected return? What is the timeline to break even? Does this specific degree from this specific institution at this specific cost make financial sense given your actual career path?
Sometimes the answer is yes. Sometimes it's a community college for 2 years and then transfer. Sometimes it's a trade or a certification. Sometimes it's building skills and a portfolio while working. The point is that the decision deserves real analysis, not just cultural momentum.
Okay, second piece of advice. Buy a home as soon as you can. Stop wasting money on rent. Build equity.
We've touched on this before, but in the context of parental advice, it deserves its own conversation. Because for our parents, this advice was almost universally correct. They bought houses that appreciated dramatically over 30 years. Home ownership was the primary wealth-building vehicle for the middle class for most of the 20th century.
And so when they look at their paid-off home and the equity they've built, they're not wrong that it worked. It worked enormously well for them, in their timeline, in their market.
But here's what changed. Housing prices relative to income have shifted dramatically. In the 1970s and 80s, the average home cost roughly 3 to 4 times the average annual income. Today, in many major metropolitan areas, that ratio is 8, 10, 12 times income.
Which means the down payment alone, the 20% that every parent and every financial advisor recommends, has gone from something a young person could reasonably save in 2 or 3 years to something that takes the better part of a decade in many cities.
And during that decade, while you're grinding to save the down payment, your parents are asking you every holiday why you haven't bought yet. Because in their experience, waiting to buy was the mistake. In their market, the longer you waited, the more it cost you.
In some markets today, the longer you wait, the more financially exposed you are if the market corrects. In others, the opportunity cost of locking up all your capital in a down payment genuinely exceeds what you'd gain in equity. It genuinely depends on where you are and when you're doing it.
The advice our parents gave was correct for a world where homes were 3 times income and mortgages were simple. That world is gone in a lot of places. The decision now requires far more nuance than buy as soon as you can.
Third piece of advice, and this one is so deeply embedded in how the previous generation thinks about careers that it almost feels like a moral value rather than practical guidance.
Stay loyal to your employer. Work your way up. Don't job hop. Build your career in one place.
And again, in their world, this made complete sense. Their world had defined benefit pension plans. You stayed 25 years, you got a pension that paid you for life. The loyalty was literally the financial product. The longer you stayed, the bigger the retirement income.
Those pensions are almost entirely gone. Less than 15% of private sector workers in the US have a defined benefit pension today. The number was close to 40% in the 1980s.
So the entire economic incentive structure that made long-term loyalty rational, that structure has been dismantled. And what replaced it was the 401k, a system that puts all the investment risk on the employee and gives them full portability. Your retirement account goes with you when you leave.
And the research on salary growth has been very clear for at least 2 decades now. The single fastest way for most people to increase their income is to change jobs. People who stay at one company for more than 2 years earn on average significantly less over their career than people who move strategically.
Because companies give average raises to retain people. The market gives market rate salaries to acquire people, and those two numbers are very different.
So a young person following their parents' advice to stay loyal and work their way up might be leaving $100,000 or more on the table over a decade compared to a peer who moves every 2 to 3 years for better opportunities.
And when they try to explain this to their parents, the parents hear disloyalty, because in their framework, loyalty had tangible economic value. In today's framework, it often doesn't, unless you're at a company with exceptional equity compensation or genuine internal growth.
The updated advice is this: be loyal to your development, not to any single employer. Stay as long as you're growing and compensated fairly. Leave when either of those stops being true.
Fourth piece of advice. This one is maybe the most universal, the one that crosses every culture, every background, every family.
Don't talk about money. Keep your finances private. It's rude to discuss what you earn.
And there's a social logic to this that made sense in a tighter-knit community era where your neighbors were also your colleagues and your friends and your competition. In that world, broadcasting your income created genuine social friction.
But in today's world, this advice has a very specific economic consequence. It keeps people ignorant of what they're worth. It prevents salary negotiation. It protects employers.
Think about what happens in a workplace where nobody talks about salary. The employer has complete information. They know what everyone earns. The employees have almost no information. They have no idea if they're being paid fairly relative to their colleagues in the market.
That information asymmetry is worth money to the employer. Every time an employee accepts a salary without negotiating because they have no idea what the role pays, the company wins and the employee loses.
There have been studies on this. When workers share salary information, pay equity improves. People who are underpaid find out and can ask for more or leave. People who are being discriminated against have evidence. The entire dynamic shifts when information becomes symmetrical.
And increasingly, the cultural norm around salary transparency is changing, especially among younger workers. Websites that aggregate salary data, laws in several states now requiring employers to post salary ranges, a growing movement to normalize the conversation.
Our parents' generation kept money private partly out of genuine social courtesy and partly out of a culture that was designed, intentionally or not, to benefit employers. The newer norm of transparency benefits workers, especially early career workers who have the least information and the most to lose from not knowing their worth.
The updated advice is this: know what your role pays in your market. Talk to colleagues and peers you trust about compensation. Use every tool available to make sure you're not being underpaid out of ignorance.
Fifth piece of advice, and this one is genuinely well-intentioned in a way that makes it harder to push back on.
Avoid all debt. Debt is bad. Live within your means. If you can't afford it, don't buy it.
And as a general orientation toward financial life, this is not wrong. The instinct is healthy. Debt has destroyed more financial lives than almost anything else.
But the blanket all debt is bad framing misses a distinction that is worth a lot of money if you understand it. The distinction between debt that costs you money and debt that makes you money.
Our parents' generation had a justified fear of debt because the debt available to most of them was consumer debt, credit cards, personal loans, financing for things that depreciate, things that lose value the moment you buy them. That debt is genuinely almost always bad.
But there is another category: debt used to acquire assets that appreciate or generate income, a mortgage on a property that grows in value, a business loan for a venture with real returns, student loans for a degree with a clear and calculable salary premium.
Even investing on margin, which is not something we're recommending casually, but the concept that debt used strategically to acquire appreciating assets operates completely differently from debt used to consume things.
The wealthy have always understood this distinction. They use debt as a tool. They borrow at 4% to invest at 10%. They use leverage to acquire real estate. They finance business operations to grow revenue.
The advice to avoid all debt keeps people safe from the worst outcomes, but it also sometimes keeps people out of the best ones. A first-generation college graduate who avoids all student loans might end up in a higher-earning career than if they'd taken on modest, strategic debt for the right credential.
A first-time homebuyer who is paralyzed by debt aversion and keeps renting for years while saving for a cash purchase, that person might be dramatically worse off financially than one who took a mortgage and let appreciation and equity work for them.
The updated advice is this: not all debt is equal. Judge debt by its cost and its purpose. Consumer debt on depreciating things, eliminate it as fast as possible. Strategic debt on appreciating assets or income-generating ventures, understand it, price it, and use it intentionally.
Okay. Let's talk about the hardest part of this conversation, because everything we've said so far is about financial frameworks and economic changes, but there's a human dimension here that we'd be doing a disservice to ignore.
How do you actually handle this? How do you respectfully navigate advice from people you love, people who genuinely have your best interests at heart, when you believe their advice isn't right for your situation?
Because the worst version of this conversation is a 25-year-old going home for Thanksgiving and announcing that actually,